Okay, let's dive right into this explainer. Today, we're unpacking a really fascinating case study in modern finance. We're going to look at exactly how the sweeping and, frankly, pretty volatile macroeconomic headwinds of 2026 are colliding with the micro-level realities of a regional banking powerhouse, Hilltop Holdings. If you want to understand how a financial institution actually survives and thrives when the economic rulebook is literally constantly being rewritten, well, you're absolutely in the right place. Let's get into it.
So, we have a clear roadmap for our analysis today. Number 1, the 2026 macro landscape. Number 2, inside Hilltop Holdings. Number 3, Q1 2026 financial performance. Number 4, subsidiary results breakdown. And number 5, stock valuation and outlook.
Section 1. The 2026 macroeconomic landscape, entering a new era.
To really understand the stakes for financial institutions right now, we first have to look at the broader economy. We're seeing 2.0% annualized GDP growth, but interestingly, it's heavily carried by a massive 10.4% surge in AI infrastructure spending, while everyday consumers are actually pulling back. And into this highly bifurcated economy steps a huge transition at the Federal Reserve. We're moving from the familiar status quo of the Powell Fed, an era defined by heavy forward guidance, into the anticipated Kevin Warsh era. And the Warsh Fed, it is not going to look like the Powell Fed. Warsh has been openly skeptical of forward guidance. He brings a bias toward lower rates, a desire for a much smaller balance sheet, and he's even argued that AI-driven productivity could structurally pull inflation down. So what does this all mean? Well, it creates a drastically widening range of plausible interest rate paths that banks just have to furiously model for. But wait, beyond central banking, the market is absorbing several complex, massive structural variables. Looking at this purely from an impartial market impact perspective, we're seeing severe geopolitical disruptions in the Middle East, specifically the closure of the Strait of Hormuz and the initiation of Project Freedom. This naturally drives up oil prices and fuels sticky inflation. And domestically, the U.S. fiscal math is, well, it's deteriorating. The national debt has hit a staggering $31 trillion, pushing the debt-to-GDP ratio to 100% for the first time since World War II. As Jamie Dimon recently warned, this deficit is a structural cost the bond market absolutely has to absorb, heavily impacting bond yields.
So with all of these volatile macro forces swirling around, shifting Fed regimes, geopolitical stress, structural debt, and those AI-driven growth anomalies, we really have to ask the critical question: how does a specifically structured entity like Hilltop Holdings actually manage to weather this storm?
Section 2. Inside Hilltop Holdings, a structural advantage.
This history right here brilliantly illustrates their structural advantage. Hilltop wasn't always a bank. Believe it or not, it was founded back in 1998 as a real estate trust focused on manufactured home communities. But look at this evolution. By acquiring PlainsCapital and PrimeLending in 2012 and later launching HilltopSecurities in 2016, they completely transformed into a diversified holding company. Today they operate what they call a three-legged stool model: consumer and commercial banking, national mortgage origination, and a massive broker-dealer and investment bank. It's basically designed so that when one sector takes a cyclical hit, say mortgages during high-rate environments, the other legs keep the whole shebang standing upright.
Section 3. Q1 2026 financial performance, rapid-fire metrics.
Okay, so how did this structure actually perform under the intense pressure of early 2026? Let's check the top-line numbers. Hilltop reported a really solid $38 million in net income, which translates to 64 cents per diluted share. They achieved a 1.0% return on average assets and a 7.1% return on average equity. What's absolutely crucial here, and really anchoring these solid profitability metrics, is an $8 million year-over-year increase in net interest income. Even with all the market volatility we just discussed, they managed to grow their core loans, and they grew their core deposits. But I really want to draw your attention to this massive figure right here, 74%. This represents PlainsCapital Bank's interest-bearing deposit beta over the first 175 basis points of Fed rate reductions. Now, what does that actually mean in plain English? It means management successfully passed on a huge portion of those rate cuts directly to their customers, rapidly lowering their own funding costs, keeping a tight lid on deposit costs while their loan yields remain super healthy at around 6.5%. That is a massive, massive win for their margins.
Section 4. Subsidiary results breakdown, the three-legged stool. Let's unpack the individual engines driving these numbers. Looking at the banking and mortgage legs, PlainsCapital Bank was clearly the star of the show. They generated $47 million in pre-tax income with a very healthy 3.38% net interest margin and 5% core loan growth. On the flip side, PrimeLending is still battling severe mortgage affordability headwinds and that stubborn interest rate lock-in effect keeping homeowners put. However, PrimeLending actually successfully narrowed its operating losses to just $2 million. That's a solid year-over-year improvement thanks to a 16% bump in origination volume and some really strict cost control measures they implemented last year.
And rounding out the trio is the third leg, HilltopSecurities. They delivered a fantastic 60% year-over-year increase in pre-tax income, bringing in $15 million on $116 million in net revenues. A major driver here, a 58% surge in their fixed income services revenue. In a volatile rate environment, having a robust securities and clearing business provides exceptional top-line support when traditional lending kind of slows down. It's a real game changer.
Furthermore, the HilltopSecurities team is driving tremendous value through their deep market intelligence. While a lot of folks expected 2026 to set another wild record for municipal bond issuance, Hilltop accurately predicted a drift toward stability. They are holding firm to their forecast of $555 billion in municipal issuance for the year. To put that into perspective, that's a staggering amount of capital flowing steadily into local infrastructure, showing a disciplined normalization in the market that's completely unbothered by the broader geopolitical noise.
Section 5. Stock Valuation and Outlook. Putting it all together.
So, we've looked at the macro and the micro. What does this combination actually mean for their stock valuation? Well, Hilltop carries a market capitalization of $2.25 billion. They're trading at a trailing price-to-earnings ratio of just 14.61. They boast a very efficient weighted average cost of capital, or WACC, of 4.13%, alongside a solid 2.11% dividend yield. And crucially, their tangible book value sits at $31.97 per share. Looking at these numbers, the market clearly views this specific three-legged structure as stable, yielding steady returns even when the broader interest rate environment is completely up in the air.
And management is actively proving that stability to shareholders right now. Instead of just hoarding cash and waiting for the tricky mortgage market to finally thaw out, Hilltop is aggressively returning value. In Q1 alone, they repurchased $47.5 million of their own shares out of a $125 million annual authorization, all while continuing to pay out that steady dividend. Honestly, that signals deep, deep confidence in their balance sheet.
But despite the really strong quarter, management is remaining remarkably grounded. Actually, they hit the nail on the head here. CFO William Furr openly acknowledged that deposit competition is remaining intensely high. He noted that their current 3.38% net interest margin has likely peaked, assuming the Fed stays consistent. From here, they're guiding margins flat to modestly down, targeting a more normalized 60% to 65% deposit beta through the rest of the cycle. So they aren't resting on their laurels, they're bracing for a tough, ongoing fight for deposits.
Which leaves us with this final, absolutely critical thought to chew on. We've seen how Hilltop's three-legged stool allows them to aggressively manage deposit costs, return capital, and weather the storm of the upcoming Kevin Warsh Fed era. But if a deeply diversified, $2 billion giant like Hilltop is actively preparing for intense margin pressure and a brutal fight for deposits, what on earth happens to the smaller, highly concentrated regional banks in the volatile years to come? That is for sure the real dynamic to watch. Thanks for joining me on this explainer, and keep questioning the numbers.